Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today is Friday, so what do we have but our Primary Vision Frac spread count? And we'll keep this show a little bit shorter because we did the econ show, a day later. So we captured a lot of things. So we'll try to keep it, just go through some of the big things that have come out. We're going to look at frac spreads, rigs, the Chinese data loaded. So we have some of the Chinese updates, and we're going to go through retail sales. And then what does that mean for some of the growth expectations that we have heading into October? And, just what are some of the other, key pieces that came out today, and then we'll pick everything up again next week. So it was just to get going on what everyone is here for, which is the Primary Vision Frac spread count. We went up by 5. So we went from 263 to 268. And if you remember last week, one of the things that we were saying was the NGL side was going to get some more support, especially on the wet gas and liquids. And at the same time, we were going to start to see activity coming back in the smaller basins, and we had that pretty much across the board except for 2. So right now, there's only 2 basins that don't have 3 basins that don't have a frac spread in it, and that will likely change as we progress through the end of October, and then as we go into November. So that's why we're, remember our target from the very beginning was 275, and right now we're sitting at 268. So we're right there. We should get to that 275 by the end of October. And if not the end of October, then the first week of November, and then we'll see some of that continue, because one of the things to think about when you're looking at the smaller basins, the whole idea is to really try to maintain production in those levels in those regions, and that's what they're going to do as we go into the end of the year, just to set up well for 2022. On the flip side, we still have natural gas, obviously, at $5.42. We have LNG that is very stable, and just given on what prices are, you have to think about what is an LNG facility going to do. Well, LNG, a lot of these guys have contracted volumes, so that are under a take or pay contract, which just means that you either take the cargo or you pay for it and then don't take it. But when you look at what is happening in the market, when you price things off of Brent, you look at LNG spot in both Europe and Asia, if you're contracted, your contract is at a fixed price, which, when you think about it from the producer's perspective, or a Cheniere from this regard, you want to increase your spot loadings. So they're going to try to run as hard as they physically can, and what not only the facility can handle, but also the vessels that are available, to try to increase spot loadings. So that's where I think you're going to see, again, a lot of support for the Haynesville and continued support for the natural gas basket. In today's insights, we went through some of the NGL side. We're at the highest price that we've from the Mont Belvieu view. This is the highest price we've been at since 2018, and there's just a lot of staying power at this point. Because if you remember 2018, what did we have? We had pipelines coming on that helped debottleneck the Permian. We had the ethane, a big ethane push after some of those shortfalls, as we had new ethane crackers coming on. The difference this time is we do have supply restraints. Remember, our whole thing is we're not getting back to where we were. We're going to have an exit rate this year between 11.5 and 11.7, and an exit rate next year closer to about 12.3. But that's going to be about it. Like, we're not on our way from 12.3 to 18 million. We're going to be fixed in this bucket, which again is going to not have that supply push as we now have, and we talked about in the EIA show, those propane and ethane exports that are going to be supportive of pricing in general. And then obviously we have just propane is the lowest storage it's ever been, and we're heading into what is an unknown of the weather side, with very low storage. So again, these are some of those things that are going to be moving and help support this activity. But in order to maintain this activity, we need rigs. So our whole thing, for those that have been following us, we've been saying that rigs are going to continue to outpace where we are on the frac spread side. And we had that again with the U.S. going up by 10. You can see oil actually had about 12 rigs that come up, with gas coming down by 1. So when you look at some of these backdrops, you had directional up 10, horizontal down 2, and vertical up 2. So here's where you're starting to see this come through. You're starting to see this accelerate in general, and we're going to continue to see this on just the different sides of where the frac spreads are and where rigs are. Rigs will go faster as we start to cap out at that 275. But there's also something behind that. There's labor. How much are you paying for labor? There's diesel. There's steel. A lot of these costs have come up, and just given where crude is, where natural gas liquids are, where condensate is trading, where oil is trading, you're going to be supportive. But we have seen increases on wages and bonuses of anywhere from 15 to 30%, depending on the basin. So again, we will see some of that turn around, and that, when again, supporting not only rigs but frac spreads. Now, when we start looking at what is happening, so China had they released the crude stock in Shandong, and you can see that the only time it was higher was 2020, where it flatlined a bit. Now, this is going to be important because we want to look at what we finally got the quota. So as of yesterday, China awarded a combined 14.9 million tons of crude oil import quotas to private refiners in its fourth batch for this year. Now, remember, the third batch was really small, of about 4.42 and then million, and the second was big at 35.24. But the new quotas were essentially geared towards 3 refiners, as those are the newest, most, let's say, advanced, if you will, on an environmental side, if you want to play that game, or just based on what they're able to throw out and try to produce. Because again, you have to look at what the situation is. They on the fuel oil side, when we look at what happened on the fuel oil side, they're at a new record. So this is a record for 2021, and it's now above where fuel oil was in 2014. So on a fuel oil level, they have a significant amount and continue to store more. But then when you look at diesel and gasoline, they're at about a 1-year low on the storage side. So that's something that they're going to look to do. You can either recrack fuel oil to create something, or they're going to try to manage some of this throughput. Now, teapot refiners are up to about 71% refinery run rates, which is below where they were in 2020, but still elevated, as they have some coming back from maintenance. But when you look at the state-owned side, they're continuing to run at a fairly reduced pace, which is something that will start to come back. And as we said in September, September exports of refined products out of China was fairly strong. That's going to reverse in October. So you'll see a little bit of an adjustment, which is opening up South Korea, India, and Japan to do a bit more. So South Korea, as we said in the EIA show, is operating now at about 75%. Japan is operating somewhere along those lines. And if you remember 3 weeks ago, India was talking about they were preparing to bring down some of the runs in India, especially ones focusing on the export market, and switch and try to create more gasoline and less diesel. They have since obviously abandoned those shifts. But in order to do that, you need to go out and buy more crude. So let's look at the physical market for a moment. So as we said the other day, there's really no change on the Angolan side. Things continue to be slow. Nigeria is still searching for buyers for 25 million barrels of crude for loading in the end of October and November, which drops from about 35. So they were able to sell some over the last 2 weeks. But most of the shipments are due to load in November. But that's a problem because they're going to announce what December is going to be next week, to give you an idea of kind of where things are going. And the pace of sales is very weak for this point in time. And then when you look at why that is the case, you have to look at coming back full circle to India. So the hope was that when India came out, they were going to pick up some additional West African barrels. But if you remember 2 weeks ago, we said that the Middle East floating storage was really increasing, and we saw this going up, and that was going to be something to watch. So what did they do? Well, when you look at what happened, as we were saying the other day, they were cutting prices out of the Middle East, which does what? And that was where IOC, or the Indian oil company, went out and purchased more from West Africa and much less from, more from the Middle East and less from West Africa, which is putting them in a bit of a bind. So another hit to West African demand was the increase in purchases by India from the Middle East instead of West Africa. There's been excess of Middle East crude in the market that is trading at an expanding discount, helping to move cargoes over West African volumes. India buying more from the Middle East instead of West Africa will push more cargoes further into December, creating a bigger glut as we head into those winter months. Japan and South Korea have increased run rates, which should pull in more discounted crude on the market. But the question will remain, who blinks first? And if we'll see a bigger cut from West Africa to try to move this. So what did India buy? So Indian Oil Company bought 6 million barrels of Middle Eastern crude via tenders for November-December loading. The supplies include 3 million Abu Dhabi Murbain, 2 million barrels of Abu Dhabi's Upper Zakum, and 1 million barrels of Saudi Arabian Kafji crude. So when you look at that, there was about, not say all of it, but there was a view that a big chunk of that was going to come from Nigeria. And the fact that it didn't, and you had that excess coming from the Middle East, creates a bigger problem when you look at how are we going to clear some of this going forward, as obviously prices continue to remain elevated. So now when we look at what is happening in the some econ data going forward, and I'll call out some of the individuals that we talked to on Twitter. So I'm always happy to answer questions, have open dialogue, debates, if you will, going back and forth on the value of some pieces. And one of the interesting things that was brought up was looking at container rates, because remember in the econ show we talked about how container rates are falling, and the view was that that's going to be enough to take away some of the inflation, but the cost of the goods are going up, which is going to offset that. Now we got some color that right now the goods in the container have increased in pricing by 5 to 10%, but container prices have fallen about 50%. So even though you're seeing the value of what is in the container going up, that container rate is going to be a big benefit in terms of taking away some of those price increases. And again, that is a net positive when you're looking at just pricing as it comes onshore. Now, one of the other things was, as you can see with retail sales advance, the estimate was for a negative. I was expecting it to also come down. It did not. And that was there was an individual on Twitter that was saying that, look, based on what they were seeing on the ground, they are not seeing the slowdown that we've been talking about, that some of the leading indicators have been showing. And he was dead right. And one of the things that is always difficult when you think about the consumer is fickle. So you can say one thing, but then how you spend. So when you look at consumer confidence, when you look at the University of Michigan, you would assume it's like, all right, well, some of this is gonna start to slow down. But when you look at retail sales, it's all based on value. And it just shows that as prices are going up, we still have people willing to pay the higher price. So its volume hasn't dropped, or if it's come up a little bit, but the value has been added, which again is driving some of this growth, where people are willing to still pay up to meet whatever means they are. So the question is, when do they stop paying up? When does the consumer finally say, you know what? No, this is enough? And we don't know. We can try to assume, when you look at what's happening in October, especially some of the leading indicators, you would say October is going to be softer, but you could have said that in September. But some of the things are a little bit different, where the Michigan sentiment had a little bit of a bounce last month. Now they've reversed a bit. So you're starting to see some of that exuberance that was in September starting to come down again in October. So there's some things that are starting to pivot. So now when we look at the contributions, we can look at just where things are in terms of so higher gasoline prices prompted a strong gain in gas station sales, which were up 1.8%. Households are also feeling the pinch of higher food prices, a factor behind the strong gain in food and beverage store sales in dollar terms, up 0.7%. So right now, when you look at food and gas, people are still saying, you know what, that's a high price, but I'm still going to pay it. Now, one of the things that we think changes that is when people get that sticker shock for heating season, when they look at what their natural gas bill will be, their heating oil bill will be, and that will start to accelerate this. But again, the consumer's fickle. It could happen in October, accelerate in November. There could be another increase in October, and then November is where this hits, and that's kind of the nuance when you're looking at math versus trying to capture what is going to happen next. So then when we look at the retail sales control group, you can see that the expectation was to be up 0.5. It was up 0.8. So this is weighted more towards goods. So we'll want to look at see what services are. So if this was strong, I would assume as well services will also be strong and put in a good close to September. Even though when you look at the GDP estimates, they've come down a touch from 1.3% to 1.2% for Q3, just because on the others a lot of the other stuff has weakened a bit. Import prices came down a touch. They were expected to be at 0.6%. They came in at 0.4. Then when you look at export price index, it was expected to be up 0.7, came in at 0.1. So you're starting to see a little bit of a slowdown, but we think there's one more of that surge. And then as we were talking from Twitter, then you'll start to see some of that normalcy come down as container rates have fallen, and you'll see some of that pickup. So then when you look at Empire Manufacturing, big swing and a miss. The estimate was for 25, came in at 19.8, and the prior was 34.3. So it's just another regional kind of manufacturing piece where you're starting to see that kind of catch up. And then that harkens back to what we talked about in the econ show, where inventory to sales ratio is actually starting to go back up. So you're now starting to get a little bit of a pivot, and there's a mixture in that. Is it because inventories are building, or because sales are slowing, or is it a mixture of both? So when you look at these retail sales, you would say, well, it's because inventory is starting to catch up because retail sales still haven't shown that. Or are we starting to see a little bit of softness on sales just as inventories are increasing? We're going to have to wait to get a bit more clarity. Then when you look at, business inventories coming in at 0.6, last month they were 0.5. So you're seeing like a little bit of that increase on the inventory side. University of Michigan sentiment came in at 71.4, was expected at 73.1. Current conditions went from, was expected to be at 81.3, came in at 77.9. Expectations continued to fall from 69.1 to 67.2 as inflation expectations moved higher. So here's when you look at where we are on the retail side. So adjusted retail and food service sales total, again, just going sideways up here. Retail sales came in at plus 0.7% versus the estimate of negative 0.2. Sales in ex-auto, again, coming in very strong. And then when you look at that percentage, you get an idea of kind of where we're sitting. On a real basis, they're coming down. But again, we're looking at just that value at this point. And then here's where we can see where there was a big increase in the different pieces, totaling the total retail, core retail. Gasoline stations had a nice little bounce, as well as when you look through sports and hobby, non-store retails. And when you look in September, you had a big move pretty much across the board, with a large part of that being on the core retail side, which again is looking at some of the things that may come under a bit of pressure as we progress forward, and prices continue to go higher. When we look at gasoline now at over $3.30, when you look at diesel now well over approaching $3.60, and this has only happened over the last 2 weeks. So we went from essentially $3.12 to $3.30 in a 2-week period, and that's where it's going to take time to see how that's really going to impact on an inelastic versus elastic basis. Then when we look at the U.S. Weekly Consumer Comfort Index, you can see it's continued to weaken. It's now back to the lows of April. And again, looking at some of these things as when does that start to show up? And then when we take that to the next level, there's a downtick, obviously, in the University of Michigan. You can see it's off the lows, which was the bounce that then showed up in retail sales. So when you look at it, sentiment in total fell. And when we try to extrapolate going forward, those expectations continue to come back below where we were right around the peak of the pandemic. But when rounding this out, looking at the October, when we look at U.S. Empire State, so October Empire Manufacturing down to 19.8 versus an estimate of 25 and 34.3 in the prior month. So here, prices paid went up, prices received went down, new orders down, and work hours down. So when you're looking at this, new orders is projecting forward. So through October into November are falling. And then unemployment dropped as well, but importantly, key components are still in expansionary territory. So it's kind of a mixed bag, which is why we're sitting at this level, well off the highs, as we've been talking about. Looking at the regional side, we're past that peak, but we're not going to contract. It's just we're not going to grow as strongly as some of these early indications are, as we continue to see these estimates missing on some of these key leading indicators. So that's all we have for you today. If you have any questions, always happy to take them in the comments section, or you can always find us on Twitter, where I'm happy to have a conversation. You can DM me, whatever you're comfortable with. So we hope you have a great weekend. Thanks for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.